Let's get to markets and some squawk picks. Joining us now, Sarat Sethi, DCLA Managing Partner. Sarat, good to see you.
Good to be here. Thank you for having me.
Really quick, I mean,
Okay.
I think the cliche is it's actually now a stock picker's market. Does it feel that way to you?
It does. It feels a lot more, just because if you look at the index, and we've talked about this at length, the 10 stocks, et cetera, but you go below and you pull back the curtain, there are a lot of companies out there that haven't done anything in the last 2 to 5 years. And if you take an example, a JNJ, it's been flat.
Yeah.
Right? Trades at 14 times earnings. It's got 5 to 7% earnings growth with a 3% dividend yield. You're looking at a 10% grower if the multiple stays where it is at 14.
Yeah.
I mean, there's been reasons for those companies, like a Johnson & Johnson with some of the litigation that was overhanging.
Right. So you got the talc overhang, right?
Yeah.
Which we hope by the end of this year is done, because it's been a couple of years. And we all know majority of the time when that overhang goes, that multiple starts expanding. Or even if it doesn't and stays at 14, you're still going to get a 10% growth with a AAA balance sheet, right? So you've got M&A activity now that you can have that you didn't have in the last administration. So I kind of look at the margin of safety, strong balance sheet, potential overhang, a catalyst, and then, where do we want to go from there?
Yeah, I mean, the market's only wanted Lilly, basically, among the U.S. pharmacists. So we'll see if that changes.
Yeah, so it was, it's that bifurcation in tech, right?
Yeah,
We
exactly.
only want AI stock. So, hey, if you want to play AI, look at a Workday. Right?
Yeah,
Workday,
I was going to say, that one's moving this morning on a restructuring plan.
Well, that's the interesting. Our thesis on that is the margins were at 27%. The goal is to get to 30. Well, one of the ways you do it is to cut people. So they just announced this morning that they're cutting 8.5%. Now, that's one way to do it. The other way is to also grow into it, which we think Workday is going to do. They've got a huge addressable market. International is growth. That's ERP software for human resources and financial systems. And the potential there is that's where you can use an AI, right? That's where you can use data management and you can use all the analytics on there. So there's a company we think that has a big, long runway ahead of it.
Is the perceived risk that somehow AI can let you kind of leapfrog those entrenched providers of something like a Workday services?
Well, it would be, but the thing is you need the data first. And Workday has the data. It's like Oracle, Workday. It's very hard for companies to say, as we all know, whenever a company does an ERP movement, probably don't want to touch the stock for two quarters. So a lot of them stay with there, and then if the information's there, it's just application software, and then companies like Workday can charge more for it. And the higher margins, recurring revenue. So that's it. But and if the application's there, then the incumbents are hard to do because you've got to get the data on that.
Thermo Fisher is a name you like. This is one that's been the story has been a little bit dislocated for a while. Right? It used to be this massive kind of melt up type of name. Everyone loved the model. What's happening now?
So COVID came, stock went through the roof, and then of course after COVID fell off. It's the premier life science diagnostic company. It's you go there for everything. And really, in the last couple of years, nothing was going on. You didn't have any.
You're talking about like lab equipment,
exactly,
all the tools and
all
stuff.
The tools that you need to do the research on biologicals, to do more research in medical, the whole industry, and really, so the company's now on the offense. It's going to do acquisitions. It's an acquisition machine. It's growing double digits, and really, it doesn't matter whether it's Novo or Lilly or J&J. It will win no matter what. And it's not dependent on China. Only 8% of its revenues are in China. So that's another thing we want to be careful going into it. It doesn't mean you have to avoid it. It also means you can have a lot more volatility with some stocks that have more exposure. So again, beneath the big market, there are opportunities out there. It doesn't mean you don't have to own the big boys, but you can own a lot of these other companies, solid balance sheets, growers, and then you have margin of safety along with it.
What makes them attractive now? Why now versus over the last 3-4 years?
Well, Thermo, just because it had the COVID bump and kind of came and sold off. You also have in these places, these companies can do acquisitions now, which we really didn't do. So I find that attractive with solid balance sheets. They're not dependent on the credit markets, so you want that as well. So if rates move up or down, it's not of any.
Do you do the next derivative down and look for the companies they might be acquiring and say those would be attractive?
I will tell you, in doing this for 25 plus years, I've never been right on those, right? Because if you think so, the company's going to get acquired and it doesn't, and they have something, because sometimes those premiums are built in already, especially if the rumors are going.
Right.
So I really like to be with the leaders that are going to integrate them. And look, if it happens and a company gets taken out, great. But you know, that's a very different game to play there.
Yeah.
Obviously, we got a lot of sort of pinball with the earnings reactions we're looking at this morning. I mean, Uber, it looks like it's going to back off. Is this one that we've tracked for a while?
We've owned it for a while. We sold half our position last year. Then the stock went down to the 60s, so we said, okay, let's back off. I mean, it's a great company. It'll be interesting to see. I haven't seen what they've said, but you know, it's cash flow positive. There's growth there. The fear is always, can the autonomous driving come there? So I do like it. It'll be interesting to see, but I think them and Lyft, but they're the premier player in this area. So and they've got international growth as well. So.
It's always wild to say this like $160 billion company is going to trade up or down a few percent in a given day because maybe down the road there's going to be a fleet of Tesla robots.
It's amazing how that information can move in Uber. And again, and Uber is one of those stocks in your portfolio that's high beta. So you're not going to get a 2-3% move on earnings anyway. It's normally one of these will go up 5-10 or down, and it'll settle in. And it's had a lot of different investors in it. It went from momentum investors to value investors to now where are we actually? So you have to watch that investment.
Yeah, it kind of did nothing for years. Yeah.